Coming up today, the Dow Jones hits a record high. Is September going to finish higher? Fed officials get more dovish. Can they pull off a perfect landing? More interest in Intel. Is Iran backing down? And why the future got clearer this weekend. It's another big week, guys. Let's have a good one. And welcome back everybody to the Daily Market Review and a typical quiet start to the week. S&P 500 57.18 trading on a narrow range again. However, we do have the potential to have another big week with a few key data points set to be released. We've got home prices coming out tomorrow along with consumer confidence. Thursday we're getting the interest rate decision from the Swiss National Bank. We also get the third estimate of second quarter GDP, along with weekly jobless claims, and we'll get to hear again from the big man himself, Jay Powell, along with a bunch of other Fed speakers this week. We've already heard from a couple today, and I'll share with you in a minute what they actually said. But the big one will be Friday, Fed's preferred inflation gauge, personal consumption expenditures index, PCE, along with personal income and outlay. We'll get to take another look at inflation. They, along with the market, will be hoping that it's continuing to track down. Certainly don't want any upside surprises on inflation right here and now. But overall, going into all of that, the market color's looking quite bullish. However, short term, we could be a little overbought. We can see my reversal signals indicator firing off the third consecutive red arrow, which can mean the market's ready to take a bit of a pause, consolidation, or pullback. However, just looking at my updated seasonality forecast indicator here up the top, it is forecasting some bullishness the next 2-3 days, and this is measuring trading days. So 5 days is 1 calendar week, 10 days is 2 calendar weeks, and 20 days is 4 calendar weeks. And by default, this looks at data over the past 5 years. So from this day onwards, over the last 5 years, the next month, S&P is typically up 2%. And if you're a paid indicator member of mine, then please allow 48 hours for Seasonality Forecast version 2 to be added to your TradingView account. And if it hasn't been added after 48 hours, please contact us with an email to support@clickcapital.io, as there has been some issues with the TradingView backend and not adding new indicators to our members' accounts. But we can get that fixed up for you really quick. We've also got some other indicators been updated this week, and I'm also excited to share some brand new indicators next week, unlike anything you've ever seen before. These are unique premium indicators that you won't find anywhere else, and so stay tuned for more on that later on. Also stick with me today because I'm going to talk a bit about nuclear energy and uranium and what lit up that market today. See here, the ETF URA up over 3%, which is more great news for nuclear bulls like myself and my stock picks members. Our portfolio having another good day. However, just going back to the SPY chart and to switching over to the monthly time frame, then if we just double click on the chart, looking at the monthly chart, the SPY here, we're also getting some reversal signals showing the market is a little stretched here. Now keep in mind, bearish technical signals aren't as strong as bullish, especially in the stock market. Sometimes they can indicate strength in the market, persistent buying, like we saw in 21. Market didn't top out for a few months later, and back in 2017 as well. However, the last time we got the bullish signals was all the way back in early 2009, which it nailed the low. And this is kind of similar to my S&P 500 oscillator. This indicator looks at market internals, breadth, VIX term structure, a lot of things, not just the technicals of the S&P 500. Usually the bearish signals don't hold as much strength as the bullish signals. You can see there it nailed the low on the 5th of August. And prior to that, in April and back in October and November last year, it was giving us indications the market may have found a bottom. So just getting back to the SPY monthly chart, the market is a bit stretched here, but it can keep on running. What I call walk the line. Kind of just hugs this overbought zone and kind of just stay there until something breaks. And so usually September and October is a very volatile, seasonally weak period in the stock market. In fact, the last 4 Septembers, S&P 500 actually finished down. And so far this month, we're up a bit over 1%. Of course, all those gains could be wiped away just in one trading session. However, the market does seem to be trading on firm footing here on the back of a really loose Fed, who once again got even more loose and dovish today. We just heard from several Fed officials who are suggesting the door remains open for another 50 basis point cut. Like I said yesterday, all public-facing policymakers have gone uber bullish in their rhetoric and language at this point of time. Janet Yellen also saying last week 4.75 is far too restrictive interest rate policy. Even though she said the US economy is doing great, inflation's still not at target. We also heard from Goolsbee and Kashkari, who are suggesting they're open to another 50 basis point cut, sending strong signal to the market. This Fed is really loosening monetary policy and being very supportive of this market at a time when nothing is actually breaking for the here and now. In fact, they also said the labor market is not flashing red. The same officials calling for big interest rate cuts, saying they're cautiously optimistic and that they don't see a recession around the corner. So is there more to this than meets the eye? Or is it like Evercore founder Roger Altman says, economic conditions are nearly perfect and the Fed has engineered a miraculous achievement? Is the Fed pulling off the most perfect landing in history? Or are they just getting better at understanding data and understanding the economy and adjusting interest rates, learning from history, maybe with the help of AI. They certainly increased rates in one of the most aggressive raising cycles. Maybe they're going to do the exact opposite, really aggressive easing, and maybe actually prevent a recession by swiftly lowering the cost of capital and getting in front of a weakening labor market. Maybe they can actually pull off what they're trying to achieve and prevent a recession. However, can they do that whilst also bringing inflation back down to under 2% and it consistently staying there? Or will all this come at the cost of 3 becoming the new 2 when it comes to inflation? Got an interesting graphic out in the Wall Street Journal today showing what happens to markets when interest rates fall. Looking back at the S&P 500 one-year performance following the first in a series of rate cuts. 1984 up 10%, 89 up 14. The mid-late 90s did well. However, not in early 2001. S&P actually came off 10%. Did even worse in 2007. Came off 17%. And apart from that sharp short spike from COVID, Fed actually started cutting in mid-19. S&P was a bit higher a year later. Just looking at treasury yield, not huge changes as the market really kind of prices it in by the time it's happened. So it's almost 50-50. Whether yields are up or down a year later. But the last 2 times they were down. Also, the US dollar tends to weaken in a rate cutting cycle because it becomes less attractive to foreign investors who are choosing between different currency. They are typically seeking the highest returns on ultra-safe investments, tend to closely track benchmark rates set by central bank. And gold, often perceived as a haven and a hedge against inflation, tends to benefit from rate cuts as well. Got a really cool chart today coming out of Bank of America and their quant department, in which they've created what the average cycle looks like in the S&P 500. Down the bottom here, trading days relative to market peak, with 0 set at a typical market peak, 500 days leading into that. Remember, the average calendar year has about 252 trading days. So that's about 2 years, out to 1,100 days. So a bit over 4 years. And so a few observations. One, just how vertical market peaks can be going into it and coming out of it. It'd be really quick distribution, really sharp falls. When the market does turn, it can just turn so hard. Then we wave up and down. In that final stage 4 decline, the market will bottom out, consolidate, retest, bounce up, form a base, stage 1 accumulation, then into a stage 2 advance where we keep going. And that kind of grinds higher in a persistent manner. We can have a few dips, periods of consolidation. Then it moves into that late stage 2 advance where things start going parabolic, melting up. And like I said, we can have a quick stage 3 distribution before going into the stage 4. So potentially this market right now, S&P 500, could be getting into a late stage 2 advance. There is the potential for things to go parabolic, especially now we've got an ultra loose Fed that wants to keep cutting big while the economy is expanding along with corporate profit. And that's kind of what's different this time compared to all other rate cutting cycles. If you look here in the black vertical lines is when the Fed's first cut back in the mid-70s, early 80s. In the light blue is S&P 500 trailing 12 months year-over-year earnings per share, expressed as percentage growth. And what you'll notice is when the Fed first starts cutting, typically earnings have been tracking up for a few years, and then they sharply contract, if not already contracting going into the first Fed rate cut. Saw that in the mid-70s, the early 80s, the mid-80s, the early 90s we had some economic weakness. Earnings were already tracking down in the mid-90s. They're already pretty bad in the late 90s, pretty much fell off a cliff in the early 2000s, trending down in 07 and already trending down in 19. The difference this time, earnings are actually in a recovery. They're expanding, and the Bank of America forecast, along with the rest of the street, is for earnings to continue expanding going into next year in 2026. So if you've got corporate earnings expanding along with it GDP, while the cost of capital is going to keep coming down, the Fed wants to get it back down to a 2 handle. Seems they don't really care about inflation anymore, at least not for the here and now. That is really supportive of a higher stock market. Of course, if all that happened, we may get a surprise or two, and that could change the picture very quickly. And so who has a lot of leverage in this economy, not just in America, but all around the West, are cashed up baby boomers, enjoying the good life. Most of them out of the workforce, and by some measures, they have over 2/3 of society's wealth. They got cash to spend, and spending it they are. However, they could be an underappreciated risk in the market, because their big discretionary spending is likely to be influenced by the performance of the property and stock markets. We see some more pullbacks in property, and if the stock market were to take a bit of a correction, that could be exacerbated by baby boomers seeing their retirement funds on their monthly statements going lower. They might cut a vacation, they may cut a cruise, they may put off that new car purchase, they may put off some home renovations, but otherwise, it's a pretty good setup for the economy. They have so much wealth, they don't even need an income. They can keep spending down 2 to 4% of their nest egg each year, and that's a lot of spending in the economy, as they hold about $80 trillion worth of wealth just in the US alone. So the Fed's made their position pretty clear. Ultra dovish, just done a big rate cut, potentially going to do another big rate cut. That's kind of all become apparent now. The next thing we'll be turning our attention to is not only the jobs market and inflation as usual, but the big one around the corner. In about 6 weeks from now, federal election. With some like billionaire Ray Dalio saying this could be the most consequential election of his lifetime, and what direction America goes from here. Not only for the next 4 years, it could have consequences for the next 40 years. And it is typically October, the most volatile month in the market. Looking at the VIX index, looking at when we've seen big market events. Black Monday, October 19, 1987. 1929 had their big crash in October. Now it's the month right in front of potentially the most consequential election in America that all of us have ever seen. Things could still get spicy. Also keep in mind the US stock market has been on an absolute tear this last 15 years compared to the rest of the world. In fact, now at 3 standard deviations, the performance above other developed markets, looking back in history. Largely thanks to the Magnificent Seven, US tech companies absolutely dominating global markets. That doesn't look to be going anywhere anytime soon. Certainly no big tech companies coming out of Europe to challenge them, nor will Asian tech companies ever take foothold in Western markets. So there is good reason for this. Big earnings expansion, big tech monopolies on the important tech industry. Just head and shoulders the last time we saw this kind of move with the Nifty 50, the hot stocks back in the late 60s, early 70s. Not even the internet bubble did the US significantly outperform the rest of the world. What's different now is not only has US mega cap tech absolutely dominating the world, you've also got significant underperformance in Europe at the same time, where innovation and productivity lags well behind the state. So the question is, how much further can this chart go? How much further can the US stock market continue to outperform the rest of the world? And what happens if Asia, led by China, catches up? Maybe we'll see a big reversion to the mean over the next 5-10 years. And part of the stellar US stock market performance over the last 15 years, one of the best gainers, Tesla, having another great day today. We got research coming out of Barclays. They're expecting Q3 deliveries at 470,000 vehicles, beating consensus at 460,000. They expect strong sales in China and sales in the US to be up 14% in July and August. We'll get Q3 delivery numbers on October 2, and the big robo-taxi event is penciled in for October 10. Market looks to be getting excited going into that. Approaching yearly highs around $272 a share, trading up almost 5% today. And again, looking back over the last 5 years, the next calendar month, 20 trading days, has been quite bullish for Tesla, up on average 17.91%. And so if they do beat on deliveries, that could set Tesla surging going into the robo-taxi event. Of course, if the market's holding up as well. We're getting more action around Intel today. After we got news last week that Qualcomm had approached them potential takeover offer, we're just getting news today of a potential $5 billion investment from Apollo Global Management. The deal's not yet finalized. They're looking for some equity, and it appears Intel is in play. Could be a potential target. May see another bidder throw their hat in the ring. This comes after Intel announced 15,000 job cuts and suspended its dividend just last month, reporting a loss in its foundry segment. Stock had been smashed after last earnings, after already trading down this year. But like I'd been noting of late, there's signs of accumulation. These big fat green candles showing up while the stock seems to be stalling out at $20 a share. Popped up another 3.3% today on volume. And so at $96 billion, acquirer probably have to pay a good 20-30% premium. Who knows, maybe 40%. That's still only $120, $130 billion, which with some cash and financing, quite a few companies can actually afford that now. So we very well may wake up to news one morning just around the corner. Intel receives a formal buyout offer of $29 a share, or somewhere around there, maybe 30, 31. And we'll see a nice gap up to just under the takeover price. We also got some moves coming in the defense and aerospace sector today, one of the best performing sectors of late, and over the last 20 or 30 years as well. Industrial military complex has done very well. And in my opinion, it's always in their interest to keep global wars going, to keep the flow of weapons going around the world. There's a lot of deep-seated interests in seeing all that continue. However, today we just saw the hot little stock AeroVironment rip up today as the US Army awarded them a $990 million 5-year contract for Switchblade, which is a loitering munition system. However, after the award in mid-September, AeroVironment disclosed that the Army award was being protested by other suppliers. Protests aren't all that unusual in defense business, but the Army issued a stop work order while the protest was being adjudicated. Now the Army just lifted the stop work order, and that's a rare move, according to an analyst, as they view the AeroVironment product as critical for their new LASSO program. Certainly got the shares excited today, up almost 12% on volume, market cap $5.7 billion, and the whole aerospace and defense sector, actually the best performing sector today. A soft tape up over 1%, and it's kind of an under-discussed sector, but it's actually sitting at all-time high. Like I said, it's given exceptional returns over the last couple of decades, and that's because the US spends more on defense and military than every other country combined. Just reminds me of this famous meme, often circulated around on the internet. You don't want to F around and find out why America doesn't have free healthcare. Just moving on, we heard today Walmart plans instant bank payments, cutting out card networks. Really interesting stuff, I thought, as they enhance direct bank transfers for online purchases from later this year. Prior transactions took 3 days via the automated clearinghouse. That's the ACH network. This new feature allows instant reflection of payments and bank accounts, avoids pending transactions, reducing risks of overdraft and non-sufficient funds. As a lot of merchants, including Walmart, are frustrated by card processing fees, by the duopoly operated by Visa and MasterCard. And it's true if you think about it, and this is another good argument for why we should always have cash. We shouldn't go to a completely cashless society. The first being that going 100% digital constantly relies on a digital communications network, the internet, to always be up. Like we experienced a few months ago, half the world got shut down thanks to one glitch coming out of CrowdStrike, which even affected your host. Couldn't buy a bottle of wine. However, you think about it, you take a $50 bill, some hard cash in your hand. You go to the hairdresser, you spend that $50. That hairdresser then goes down the road, gets her nails done, spends $50. The nail shop owner then goes to her local grocer, gets some fruit and veggies, who then goes to the bottle shop and get some wine. That $50 bill is still $50. If all those transactions had taken place with a credit card, each time that $50 is getting 1 to 3% smaller thanks to card processing fee. And so now you got leading retailer like Walmart trying to cut out that middleman. That's a big threat for Visa and MasterCard, which the stock prices didn't react to at all today. Actually finished higher on Visa and MasterCard as well. And just switching over to my fundamentals chart, looking at the monthly time frame. Visa and MasterCard have been two of the best performing blue chip stocks this entire secular bull market over 15 years. Like I said, they pretty much operate a duopoly all around the world, healthy margins. And look at that stock price performance from Visa. 570 billion market cap, absolutely loved by investors all over the place. I'm always hearing on social media how good Visa and MasterCard are. However, both are a little overvalued according to my stock fair value indicator, MasterCard more so, with it having fair value at $335. And this is looking at forward earnings expectations, growth rates, assets and liabilities of the business, amongst a few other things. And so of course I wouldn't short them here. That's likely to be a losing bet with all this momentum, and for sure they could keep going on for who knows, months or even years longer. This trend of retailers trying to cut them out may take years to materialize. I see it more as they're kind of like bloated elephants, and they're vulnerable to contractions in their margins, especially from what retailers like Walmart are trying to do. Also opens up the door for competitors. We're also seeing PayPal trying to move more into the physical payments place. And this is what you'll find in stock markets and capitalism overall. It's kind of like capture the white flag, of which Visa and MasterCard have certainly done so for decades now. And like we've seen time and time again in history, when you make it to the top, the only different place you can go is down. Big companies that make it to the top rarely stay there in the long term. Something or someone eventually comes and dismantles them. And so like I said, even though I definitely wouldn't short them, I definitely wouldn't be buying them here at these lofty valuations and how much threats they're likely to face around the corner. Both kind of around $500 billion market cap. Are they really going to become $1 trillion, $2 trillion companies? Because that's what long investors are kind of hoping for here. Just moving on to global macro, we've still got short-dated bond yields trading pretty flat after the Fed. They certainly did a lot of front running of this big Fed move. Jay Powell pretty much bowing to the market along with his political masters who are demanding him to cut big. There's the 2-year trading flat around 358 and the 10-year pretty quiet to start this week as well, 375. Also got oil pulling back a little bit today as we're getting news. Iran's president says the country is prepared to ease Middle East tensions, which if true, could mean he's conceding power in the region to Israel after we've just seen one of the most sophisticated, some calling it the most sophisticated, campaigns in warfare from Israel targeting Hezbollah. Not only with their precision strikes from the sky, in which they just killed another 500 militants and wounded more than 1,600, actually finding their missile sites and blowing them up an hour or two just before the missiles are about to be launched into Israel. They also infiltrated their entire supply chain, installing explosive devices and numerous communications and electronic equipment used by Hezbollah. They actually purchased them straight from a shell Israeli company. Not to mention the largest presence of US military assets in the region, ready to coordinate with the Israelis and respond to any attacks from Iran, letting them know that if Iran goes big again this time, so will the Israelis, in which Iran looks to have decided not to go big, and like I said, maybe conceding power here. With the open source intelligence monitor saying, Israel in 12 hours has practically crippled Hezbollah's offensive capabilities, and in retaliation, Hezbollah has done almost nothing besides wildly launching rockets at Israel, causing only minor damage to a few buildings. It really shows how far Hezbollah has fallen. And so Iran may be facing the reality that they're simply outbeat. They've seen what's happened to their subsidiary Hezbollah, and they don't want to face the same consequences either. However, of course, that could change, but it looks like for the here and now, Israel is winning this war, and they just took an even larger leadership. Not a huge reaction in the crude oil market, just pulling back ever so slightly, currently sitting above $70 a barrel. We also heard Bank of America come out today and said investors shorting oil are walking into a bear trap with energy demand set to surge. They expect 3.3% growth in global GDP next year. That's going to spur a surge in energy demand. They're noting the AI boom will increase data center demand, and that there's a large short positioning in the oil market as the world's flush with supply. The potential improvements coming out of AI to drive productivity and efficiencies, along with the growth in clean energy, along with the most supportive US government we've ever seen in the oil market, releasing the largest amount of oil from their strategic petroleum reserve, which they have started replenishing over the last couple of months. However, it's still at levels last seen in the early to mid-1980. After Russia went into Ukraine, current admin released a lot of oil into the market to counteract that. However, just moving on to a significant story we got out from the nuclear industry over this weekend, with a big structural change coming from the world's biggest banks pledging their support for nuclear power. For a long time, the establishment has looked at nuclear as too risky, uninvestable, and so a lot of the nuclear uranium industry has struggled with financing. However, like I've been saying for a little while now, the world's turning around to it, and we just heard that over the weekend at a climate conference in New York that 14 of the world's biggest banks and financial institutions are pledging to increase their support for nuclear energy. And so this is great news for nuclear uranium bulls like myself, because we've got the biggest capex spenders in the world, mega cap tech, starting to get into nuclear energy and partnering with these companies to build their data centers right next to nuclear power plant. Nuclear is the most powerful, cleanest form of energy, and now we've got big banks coming around to it, helping to finance all that. This is great news for the industry. Another big green light. And so, like I believe, this is just the beginning of the resurgence of the nuclear energy. And this is a theme that can play out over the next couple of decades. And this was on the back of news we got last week of Microsoft signing a multi-decade agreement with Constellation Energy to fire back up 3 Mile Island. That was the site of America's largest nuclear accident back in 1979. We've also seen similar moves from Microsoft and Amazon. They're actually looking to hire nuclear engineers. Oracle's Larry Ellison has expressed an interest in doing the same himself. And the forecasts for their capex is only set to increase. Last year was about $150 billion. It's expected to be almost double that in 2027. And that's why we got that clean pop today in the uranium sector. URA up over 3%, ticking higher after hours as I speak on good volume. Just like I'd been noting to you guys over the last few weeks, was getting big signs of accumulation, and that's why my second last stock pick for members back here was in the uranium sector. It wasn't this ETF, it was something else. And that's up more than double what this ETF is today as well. And I plan on continuing to add more exposure to this sector going forward as well. There's a look at the economic calendar today. PMI is coming in a little mixed, manufacturing a little soft, services still holding up. Tomorrow we've got consumer confidence, Wednesday new home sales, Thursday durable goods, GDP, few Fed speakers, weekly jobless claims, then the big one Friday. Core PCE index expected to come in 2.7% year over year, 0.2 month over month. That'll be the biggest data print this week. And Fed fund futures are believing those Fed officials and how dovish they are. We're back to another 50-50 pricing between 25 basis points and 50 basis points come the November meeting. If the market's right, we could have a Fed funds rate around 4% come Christmas. Simply incredible how swift and sharp the Fed's starting off here. Unlike anything we've ever seen before, given the economic backdrop. Which again, barring no surprises, should be very supportive of the stock market. Although for the here and now, we do have some seasonality that is weak and volatile, along with the November election. However, all public-facing federal officials are very supportive to try and counteract all that. They definitely don't want to see a crash anytime soon. And option dealers appear to be jumping on board. VIX now getting back down to a 15 handle. Volatility risk premium, 2 points. High yield bonds still sitting at yearly highs. Dollar still tracking in the support zone at 100. There's Bitcoin just catching its breath. It too has a bit of bullish seasonality coming into it. There's gold a little stretched. A few reversal signals. A lot of traders and investors talking about it. A little bit of bearish seasonality over the next week or two. So we may see a pullback in gold. Inflation expectations holding up. We'll see how this moves after PCE this Friday. There's a look at Apple taking a little dip today, and Nvidia still consolidating just along the 50-day, but that has quite a lot of bullish seasonality over the next 2 to 4 weeks as well. So we'll just see whether these reversal signals play out on the SPY. It stops to catch its breath, consolidates, see how the market reacts to PCE. Otherwise, like I said, the Fed is ultra loose, really supportive of this market, and any dips are likely to get bought. That's all for this Monday, and I look forward to breaking it all down for you again come tomorrow. Cheers.